Hello, my name is Derek Afasi. Today's topic, I want to discuss with you briefly the difference between an immediate annuity and a fixed annuity. Now, whenever you hear the word annuity, I want you to think of income generating vehicles. It's either going to be income now, income at a future date, basically leveraging these vehicles, these income vehicles, to maximize an inheritance. Whatever the circumstance may be, that's the way that you could leverage annuities in your favor. Now, annuities, they can only be sold by insurance companies. With a regular insurance company, let's take a life insurance company for example. One would purchase life insurance to hedge their risk of dying too soon. They would say, okay, I'm going to pay X amount of money in towards this insurance company, and they're going to make sure that they're insuring my life, that if I pass away, I have a lump sum that's left to my beneficiaries. It's the risk of dying too soon. Annuities were created by the same types of companies, life insurance companies, to prevent you from living too long. What I mean by that is, in a typical circumstance, we all understand that medical advances they're growing, and essentially people are living much longer than they used to. So if you were working throughout your entire career and you were just placing money under a mattress and you had it all on cash, and you hit an attained age and you say, okay, I want to start retiring now. Let's say you had, I don't know, $100,000 for easy math. If you never leveraged an annuity or you never leveraged an insurance company, you would say, okay, well, I'm not really sure how much I could take. I'm about 65 years old. Maybe I could only live for, I don't know, 20 years, 30 years, whatever it is, but I'm going to take on that own risk. I've accumulated this money by myself, so I'm going to basically spend it by myself. So you say, okay, well, I'll go and I'll just take 5% of this money every year, $5,000 a year to live. It's extremely small, but I just want to basically show you an example of how this works. If you had your money either in a savings account or you had it underneath your mattress, if you were to take $5,000, $5,000, $5,000, $5,000, and you're age 65, what happens when you're 85? Your money is nothing. It's gone. So you say, wow, that's really scary. That means that no matter what, in order for me to make sure I have peace of mind, I don't have to try to go back to work or figure out some other way to obtain income, I need to leverage something. I need to make sure that I have some guaranteed contract out there that will allow me to take income that I can never outlive. Hence why insurance companies are in the annuity market, why they've constructed these things called annuities. They go off of something called mortality tables, and they've been around for hundreds and hundreds of years, and that's why they could understand the actuarial tables, the mortality tables. Mortality tables just basically lifespan tables. Think about it that way. If you're an average age, you're a male age 65, then typically you should be living to age, let's say 87 or 83, whatever it is, dependent upon exactly your age. What they do is they use the law of large numbers. They take your life as a male age 65 and they match that against hundreds of thousands of other males age 65. So they determine that with the law of large numbers, if you pass away before your life expectancy, they win on the deal. If you outlive what your life expectancy should be, then you win on the deal. Now the companies are very smart. That's why they use the actuarial tables, because they say, okay, well listen, we're leveraging all these little lump sums of money as one person's dying. Now if we sold them a life insurance policy, then we're going to pay out those premiums while new people are funding the policies. So you have the law of large numbers. You basically spread the risk out. That could be people that are 65, and you have 25-year-olds that are contributing into it. So you're constantly having an influx of money coming in while money's going out as well. Now, annuities were created primarily for the income aspect of basically to go against the risk of living too long. And we'll go to the very first annuity, is immediate annuity. Automatically, when you see immediate annuity, I want you to think pension. That's essentially what it is. Now, with a pension plan, and I have other videos out there to kind of explain to you an employer pension plan, but essentially what a pension plan is, it's a defined benefit plan. A lot of people get confused with the financial jargon. A defined benefit plan, all that means is that they're defining your benefit. So you worked for a company for a pension plan to be in existence. You worked for a company, an employer, whether that was a private entity, a government entity, state entity, whatever it was. And essentially they say, okay, if you give X amount of years of service, let's say 30 years of service, we will guarantee you a stream of income for your retirement. Essentially what they're doing, what the employer's doing, is they're either taking a percentage of your salary that you're not seeing, they're basically not paying you that money that you didn't even notice, or they might be telling you, okay, we're going to take a percentage of your salary, throw it in towards the pension plan, and that's being invested on the back end through the employer. They worked out perfect. For your parents, grandparents, pension plans were excellent. Why? Because it defined your benefit for retirement. You would understand, okay, after 30 years of service, I'm getting a guaranteed stream of income that I can never outlive. Or choosing one of the 3, 4, 5 options. And I'll compare the two and it'll make a little bit more sense that way. So, right around 1974, it's very unfortunate that companies understood that they couldn't take on that risk anymore. They were stating, okay, well, we're investing this money on the back end, and yes, we'll invest it into the market, something that will be growing, we'll invest it into a company's stock, basically pumping that money back into the business to guarantee all these people that are retiring and defined benefit, a defined amount of income every year. What happens is it was way too risky. So rather than everybody having pension plans, in 1974, the government came out with a branch called ERISA, it stands for Employer Retirement Income Securities Act, and it changed defined benefit plans to defined contribution plans, such things as 401ks, 403bs, IRAs, whatever it is. So what it did was it took the risk off of the employer and it threw that risk on the employee. Why this is important is the people that still have pension plans, they're the happiest clients I have. They are by far the happiest clients because they have peace of mind that an income stream is coming to them every single year. Like a pension option, let's say you worked for 30 years and you had a pension plan. Now about only 20% of Americans today, 10 to 20% of Americans today actually have pension plans. So a pension plan, they'll come to you after, let's say, 30 years of service, and they'll say, okay, Mr. Klein, Mr. Smith, we'll give you essentially 3 options. Sometimes there's more, sometimes there's 4 or 5, whatever it is, but we have 3 basic options. We will give you an option A, where it covers your life only, and option B, that covers your spouse's life, you and your spouse, so it's called joint, or an option C will give you a period certain. We'll give you, say, 15 years of a certain period that we're going to pay you X amount of money. So let's say this might be $24,000 a year. This might be $18,000 a year. And this might be $36,000 a year. Why are those numbers different? Well, essentially what's happening is they're taking the risk. If it's a life-only option, the company, the pension company, understands that if it was life-only as opposed to joint, they're covering one person. So if, just like the law of large numbers, the mortality tables, if the person was to pass away after the first year, they won on the deal. or within the time frame that they were supposed to have their life expectancy. If they pass away prior to that, then the company wins. They keep all their money. The joint option, they're insuring 2 lives. So that's why you're going to have a less of a benefit, but people have peace of mind knowing that when I pass away, at least my spouse could still continue. Or you have a period certain option, let's say, and that's exactly a period certain option. All that means is they are basically giving you an exact period. It's a period certain of how long your money will be there, 15 years. So let's say they're giving you $36,000 and you pass away in year 10, you have 5 years left that $36,000 can now go to beneficiaries. But if you lived to year 16, then all your money is gone. So people, you have to really understand, so a lot of the individuals have to understand exactly what the 3 basic options of a pension are. With a pension, it's through the terms of the employer, and I cannot stress that enough. Because when it comes time for your pension option, and I stress this so many times, give us a call, because what we do is a side-by-side comparison of what your pension option may be through income, through either choosing the option A, option B, option C, or basically creating your own self-pension plan through either an immediate annuity or other types of annuities as well. So that explains what a pension is. An immediate annuity is pretty much the same exact thing. I want you to think pension at all times. So what this does is they'll say an immediate annuity, rather than the company that had this money invested on the back end and they have this lump sum of cash, all you're seeing is just what the income stream payments would be. Now you have this lump sum of cash. So like the example before, let's say you have $100,000 that you had tucked under your mattress. Rather than taking, and you're age 65, rather than taking 5% and hoping that you do not outlive this money, you say, okay, I'm going to go to an insurance company, because that's the way that you leverage it. You leverage the law of large numbers. You're taking away your risk of living too long. So you constantly have an income stream that will be coming to you. So rather than the 5%, the company gets to leverage their numbers, and they say, okay, come to us with $100,000 and we'll give you a couple options. We'll give you an option A, an option B, and option C, just like the pension plan. Option A would be a single life only. Option B would be joint. And option C would be a period certain. And there are different period certain options. They have return of premiums. They have. I just want you to understand the basics of everything. So with the single life only, let's say you had $100,000 in there. They'll say, okay, we'll give you 7% per year. You give us the money. You surrender the contract. You surrender the money to us, but we will give you $7,000 every single year until the day you die. You live past 20 years. I mean, amazing. You're completely beating all the insurance companies. You say, okay, well, I have peace of mind. I have this income coming in. It's like my own personal pension plan. Joint option, let's say they'll give you $5,500. Cover both you and your spouse, just like in a pension plan. Period certain, 15-year period certain, same thing, they'll give you $9,000. Something that they're going to, it's not just going to be up to the $100,000, it's going to be something for your benefit. So they're using the law of large numbers, they're using the mortality tables in your favor. The reason that I say give us a call is because whenever you do a side-by-side comparison, I'd say typically 90% of the time when you have an option, a pension option through work, and you have this option of either taking your income or taking a lump sum, and you can now use that lump sum cash to then put into a personal pension plan. When you go single life only option on a pension versus single life only option or joint or whatever it is, but we'll use single life only on an immediate annuity, the immediate annuity will beat it out 90% of the time. Some are, I mean, you see some amazing pension plans out there, so that's why I state 90% of the time, but majority, it's at least worth a look to see whether you'd be getting more income. Maybe the single life pension option, they'll tell you, okay, we'll give you $5,000 a month $5,000 a year for easy math, and this one would give you $7,000 a year. You could be obtaining $2,000 more per year by going and basically utilizing the insurance company through the immediate annuity. So the immediate annuity, remember, we're thinking income streams, and we're leveraging insurance companies. Immediate, meaning that you're turning on your income immediately. Brings us to our next topic. We have something called a fixed annuity. Now, anytime you hear the word fixed, I want you to automatically assume bank CD. How exactly does a bank CD work? A bank CD is you go to a bank and you say, okay, I have $100,000. I'm scared about what's going on with the markets right now. So I want to at least have a return of my money, not necessarily a return on my money. So the way that I correlate these two, the fixed annuity and the bank CD, is it lives in a little world called the world of the known. World of the guaranteed, world of the fixed, any way you want to basically put it. What happens is between the bank CD, that's backed by the bank, and typically backed by the FDIC. It's FDIC insured, meaning that if the bank was to go under, then you have the federal government that backs to make sure that your contracts will still stay into effect. Now you have some differences there. A bank CD, let's say you come to a bank and you say, okay, I want a 5-year bank CD. Right now there are absolutely horrible rates of return, but you understand that you just want to preserve your money. You want it to be fixed. You want it to be guaranteed. With a fixed annuity and a bank CD, you understand that this gives you the world of the guaranteed, world of the known. So your interest is typically guaranteed, your principal is typically guaranteed, and your length of term, your length of time is typically guaranteed. Now a bank CD, because of their measly numbers, what they do is they leverage, how a bank makes money is they loan your money out. They basically, in reserve systems, if you're going both of these vehicles, the bank CDs, the banks and the insurance companies for fixed annuities have something called legal reserve requirements. A bank has to have, for every $1, for every $10 that they loan out, they need $1 in reserves. So they're making money by basically taking in your money and loaning out at a much smaller interest rate, and they're taking the additional. For every $1 that they're loaning out, $10 are, they're on the hook for every $1. It's a 1 to 10 ratio. So the other remaining money is now being invested through investment bankers. It's being invested to try to make as much interest as possible. They say, okay, we have the financial gurus on our side. So if we're loaning out people 1%, all we need is 10 cents on the dollar in reserves that will at least go to anybody that has their money with this bank. The remaining money is invested on the back end, and that's how they typically make their money. They basically loan it out. The example of $100,000 in a typical bank CD is they'll say, okay, you have a 5-year CD, we'll give you 1%. Year 1, you gained $1,000. Year 2, you gained $1,000. Year 3, you gained $1,000. Year 4, you gained $1,000. Year 5, you gained $1,000. At the end of 5 years, you had $5,000 into this account. Unfortunately, it goes off of simple interest. What I mean by that is it's just 1% of the $100,000. Every year, at the end of the year, you're going to be receiving a 1099 that states, okay, $1,000, that's how much you made, now you're going to have to pay taxes on that. When you deal with a fixed annuity, the most common one that you will deal with that compares, it's a CD alternative, is something called a MIGA, a multi-year guaranteed annuity. And what happens is rather than taxing you every single year, they use your money, the same $100,000 example, and they use the law of large numbers and mortality tables. So what they do is their legal reserve system is a little bit different. They have to have a 1-to-1 ratio. They have to make sure that they have reinsurers, that whatever state that they're in, they have certain state requirements to make sure that the company does not go under. Since no insurance companies for the fixed annuities, for the legal reserve systems have ever in the history of fixed annuities, insurance companies have ever gone out of business, that they were not able to at least pay out their contractual obligations. That has not happened yet. So what happens is a lot of people understand that this is safe. Because they leverage the law of large numbers, they could give you higher rates of return. Typically it could be anywhere from 2 to 4 times greater rates of returns than the typical bank CD. So with that same $100,000, they'll say, okay, well, for 5 years, we'll give you 3% per year. Now, it's not 3% of simple interest, where you're only getting $5,000. Year one, after 3% is in there, your new account value is 103. You have options, and each one is a little bit tricky. It all depends upon your situation, but you can have it where you pull the interest out. You can have it where you allow it to just basically grow. You grow tax deferred, meaning that the next year you had 103 in year one. Next year it's going to be 3% of 103. So that's more money than just 1% on 100,000. So it's not 1,000 every single time. It's going to step up a little bit, step up a little bit, step up a little bit. Power of compound interest versus the power of simple interest. So essentially, you're going to be having higher rates of return with a fixed annuity than you will with a CD. Now, they're both in the world of the known, meaning that they have that legal reserve system backing. They are not FDIC insured. Insurance companies cannot be FDIC insured, only banks can. But they need to have that guaranteed realm. They need to have that those tiers of safety to make sure that your money is safe, and they could contractually pay you out. Now, the problem that's happening. So regarding the fixed annuity, it's just, I want you to think of a typical bank CD that pays you a little bit higher rate of interest. They're becoming more popular right now because of the fact that what's happening with the stock market. Unfortunately, everyone's been spoiled. From 1980 to 2000, we've seen the largest growth in the stock market. We've seen 1,000% growth. Right now, for these past 12, 13 years, we have been seeing a sideways market. So people say, okay, I'd rather stay in the world of the safe, world of the fixed, world of the known, than go into a wealth accumulated product such as something involved in the stock market. Because you have to determine risk versus reward versus return at all times. The riskier the investment, the higher the rate of return. The riskier investment, the more that you could potentially lose. Because they're both safe vehicles, that's why people like to go more with the fixed realm. This was just a very brief description on annuities. I want to explain to you kind of how annuities came about with the insurance companies, how they use the mortality tables, the law of large numbers in their favor, and why they're able to offer you higher rates of return is because of that. They're basically spreading out that risk. And they do have that legal reserve system backing. Now, there are some annuities out there, such as the variable annuity, which they don't have the legal reserve system backing. A variable annuity is more for the person that's market savvy, more of the person that wants to go in towards the stock market. Please check out that video as well. I explain variable annuities, typically why my advisors do not sell them, why I do not like them selling variable annuities, especially in today's economic times, is because of the high rates, the high fees associated with them. Please just give us a call. The name of our website is retiresharp.com. That's exactly what I want you to do. I want you to retire as sharp as possible. You could obviously visit our website. We give you free reports. We give you other videos, personalized videos on your specific situation. So please make sure that you view variable annuities. you view the index annuities, and you also view the hybrid annuity videos as well, to kind of get a general idea before speaking with us. I mean, obviously we could explain that to you as well, but I want you to get a general idea on the world of annuities and understand why they're highly leveraged in today's economic times. Once again, my name is Derek Afasi. I thank you very much for watching this video, and call in with any questions, and we'll be more than happy to help you out.